members of the press, ladies and gentlemen, the Monetary Policy Committee, MPC, met on the 25th and the 24th and the 25th of September 2018 and evaluated developments in the global and domestic economic and financial environment in the first 8 months of 2018, as well as the outlook for the rest of the year. 10 members of the committee were in attendance at this meeting. The global development. The committee noted the uneven expansion in global output amidst growing trade tension, rising oil prices, and debt levels, as well as currency depreciation in most of the notable emerging markets and developing economies. These developments notwithstanding, there was evidence of resilient financial markets and output growth in the advanced economies led by the United States, which experienced sharp improvements in output growth. In the Euro area, United Kingdom and Japan, the pace of growth was moderate but steady, while in the emerging markets and developing economies, growth was sluggish and relatively uneven. Growth in the advanced economies was projected to remain at 2.4% in 2018, same as in 2017, led by the US, which grew by 4.1% during the second quarter of 2018 and is projected to grow by 2.9% in 2018. The Euro area and Japan, which grew by 0.4% and 0.7% respectively during the second quarter, and are projected to grow by 2.2% and 1% respectively in 2018. In the emerging markets and developing economies, and growth is expected to remain strong at 4.9% in 2018 compared with 4.7% in 2017. Growth in the emerging markets and developing economies is expected to be led by India and China, which are projected to grow by 7.3% and 6.6% respectively in 2018. On the average, the momentum of the global economy remained on track towards achieving the 2018 growth projections of 3.9% as financial conditions remain broadly favorable, with limited spillover of trade tensions amongst the general political sentiments. However, the recent episodes of large-scale flooding in major areas across the globe could pose some threat to growth. Accordingly, the Monetary Policy Committee believes that rising oil prices, tighter financial conditions, higher yields in the advanced economies, and capital flow reversals from the emerging market and developing economies, resulting in pressure on currencies of some countries with fragile fundamentals, as well as growing tensions between the US and China, would continue to shape developments in the emerging markets and developing economies in the medium term. Domestic output development. Available data from National Bureau of Statistics, NBS, showed that real GDP declined by 45 basis points as the economy grew by 1.5% in the second quarter of 2018, down from 1.95% in the preceding quarter, but higher than 0.72% in the corresponding quarter of 2017. The growth slowdown was traceable to contraction in the oil sector in the second quarter of 2018 compared with the previous quarter. The committee noted that non-oil real GDP grew by 2.05%, reflecting the strong performance of construction, services, and agriculture, which grew by 7.66%, 4.19%, and 1.19% respectively. Furthermore, the non-oil sector was similarly supported by the stability in the foreign exchange market, continued implementation of 2017 capital budget, and the ongoing interventions of the bank in the real sector of the economy. The MPC was of the view that even though growth remained weak, the effective implementation of the 2018 federal government budget, capital budget, and policies that would encourage credit delivery to the real sector of the Nigerian economy may boost aggregate demand, stimulate economic activity, and reduce unemployment in the country. Developments in the money and prices. The committee noted that relative to the level at the end of December 2017, broad money M2 grew by 2.98% in August 2018, annualized at 4.47% and below the provisional benchmark of 10.48% for 2018. The growth in M2 was largely driven by growth in the net foreign assets of 18.63% in August 2018, annualized to 27.94% and above the provisional growth benchmark of 18.15% for the year. Net domestic credit, however, contracted by 4.14%, annualized to 6.27%, in contrast to the growth benchmark of 12.45% for 2018. The contraction in the net domestic credit was attributed to the 34.68% contraction in the net credit to the government in August 2018. Conversely, credit to the private sector grew marginally by 0.81% in August 2018 from a contraction of 0.13% in July 2018, annualized to 1.21% against the annual benchmark of 5.64%. The MPC observed that despite the underperformance of key monetary aggregates, headline inflation year-on-year inched up to 11.23% in August 2018 from 11.14% in July 2018. The rise in headline inflation was from food, while core inflation declined, indicating that supply-side factors were driving the price increase. The near-term upside risks to inflation remained the dissipation of the base effects, expected 2019 election-related spending, continued herdsman attack on farmers, and the current episodes of flooding which destroys crops and affect food supply and prices ultimately. In this regard, the committee urged fiscal authorities to ensure sustained implementation of the 2018 budget, to relieve the supply-side growth constraints, as well as address the flooding incidents which has become perennial on a permanent basis. The average interbank call rate declined from 9% in July 2018 to 4% in September 2018. Similarly, the average open buyback OBB rate declined from 11.44% to 4.72% over the same period. The relative decline in market rates reflected the increased statutory allocation to states and local governments and maturing securities. The development does not seem to have been significantly transmitted to retail interest rates, as average maximum lending rates marginally declined to 30.93% in August from 31.09% in July 2018. Similarly, average prime lending rates decreased to 16.65% in August from 16.83% in July 2018. The weighted average deposit rate also declined to 4.57% in August from 4.47% in July 2018, widening the spread between the average lending rate and average weighted deposit rates to 26.36% in August 2018 from 26.30% in July 2018. The committee noted the decrease in external reserves to 44 billion in September 2018 from 45 billion at the end of July 2018. Total foreign exchange inflow through the economy fell by 38.34% to $6 billion in July from $9.73 billion in June 2018. Committee believes that accretion to external reserves should strengthen in the last quarter of 2018, with crude oil prices remaining above the budget benchmark price of $51 per barrel and oil production increasing to 2.3 million barrels per day. The committee noted the relative stability in both the investors and exporters window of the foreign exchange market, which was sustained by autonomous inflows and measures taken by the central bank to deepen the foreign exchange market and curb speculative practices. The MPC expressed concern at the decline in major capital market indices. The all-share index decreased by 14.99% to 32,540.17 on September 21, 2018, from 38,278.55 at the end of June 2018. Similarly, market capitalization decreased by 14.33% to 11.38 trillion naira in September 21, 2018, from 13.87 trillion naira at the end of June 2018. The development was due largely to sustained profit taken by portfolio investors and capital reversals as foreign yields become increasingly more attractive. The overall outlook and risks. Available data and forecasts of key macroeconomic indicators show a positive outlook for the economy in the third quarter of 2018. The committee expects the sustained implementation of the 2018 budget, improvements in the security situation, and sustained stability in the foreign exchange market will stabilize prices and strengthen economic growth. Growth in the non-oil sector, especially agriculture, manufacturing, services, and light industries, are expected to drive output growth. Committee, however, identified the downside risks to the output to include the impact of increased monetary policy normalization in the advanced economies and the strengthening US dollar. Others are the late implementation of the 2018 budget, weakening demand and consumer spending, build-up in contractor debt, low minimum wage, impact of flooding on agricultural output and other economic activities, continuing security challenges across the northeast and north central zones, and growing level of sovereign debt. The outlook for the year, however, remains positive as the economy is projected to grow by 1.75% in 2018, anchored on continued stability in the foreign exchange market, sustained high price and production of oil, and improved electricity supply. Inflation outlook suggests a mild resurgence of inflationary pressure in the economy, traceable largely to cost push factors, election-related spending, amongst other domestic factors. The moderating factors to the outlook would include improved power supply, increased expenditure on capital projects, and improved security conditions, all of which may exert downward pressure on consumer prices in the near term. The considerations of the committee. The committee appraised the macroeconomic environment and noted that at its July meeting, modest stability had been achieved in key indicators, including inflation, exchange rate, and reserves. In particular, relative stability had returned to the foreign exchange market, buoyed by a robust level of external reserves, with inflation trending downwards for the 18th consecutive month. These gains so far achieved appear to be under threat of reversal following the new data which provides evidence of weakening fundamentals. The committee identified rise in inflation and pressure on the external reserves created by the capital flow reversals as the current challenges to growth. It noted that inflationary pressures have started rebuilding and capital flow reversals have intensified as shown by the bearish trend in the equities market, even though the exchange rate remains very stable. The committee was concerned that the exit from the recession may be under threat as the economy slowed to 1.95 and 1.50% during the first and the second quarter 2018, respectively. The committee noted that the slowdown emanated from the oil sector with strong linkages to employment and growth in other key sectors of the economy. In this regard, the committee urged government to take advantage of the current rising trend in oil prices to rebuild fiscal buffers, strengthen government finances in the medium term, and reverse the current trend of decline in output growth. The MPC also called on fiscal authorities to intensify the implementation of the Economic Recovery and Growth Plan to stimulate economic activity, bridge the output gap, and create employment. Committee noted that disruptions to the food supply chain in major food producing states due to the combined effects of poor infrastructure, let me go back a little. The committee noted that the slowdown emanated from the oil sector with strong linkages to employment and growth in other key sectors of the economy. In this regard, the committee urged government to take advantage of the current rising trend in oil prices to rebuild fiscal buffers, strengthen government finances in the medium term, and reverse the current trend in decline in the output growth. The MPC also called on the fiscal authorities to intensify the implementation of the Economic Recovery and Growth Plan to stimulate economic activity, bridge the output gap, and create employment. Committee noted that disruptions to the food supply chain in major food producing states due to the combined effects of poor infrastructure, flooding, and the ongoing security challenges resulted in a rise in food prices, contributing to the uptick in headline inflation. Committee was, however, optimistic that as harvest progress in the coming months, pressure on food prices would gradually begin to recede, while growth-enhancing measures would, over the medium term, have some moderating impacts on food prices over the medium term. The MPC expressed concern over the potential impacts of liquidity injections from the election-related spending and increase in FAC distributions, which is rising in tandem with increase in oil receipts. Committee was concerned with the rising level of non-performing loans in the banking system, traced mainly to the oil sector, and urged the bank to closely monitor and address the situation. It also expressed concern over the weak intermediation by deposit money banks and its adverse impact on credit expansion and investment growth by the private sector. In view of the above developments, the MPC noted that the economy was still confronted with growth challenges and inflationary pressures. It reiterated the need for synergy between the monetary and fiscal policies as a viable option for macroeconomic stability. The committee therefore identified two likely policy options as tightening or maintaining the status quo ante. Tightening would tame inflationary pressures, stem the reversal of portfolio capital, improve the external reserves, and and maintain stability in the foreign exchange market. Conversely, The MPC felt that raising rates would further weaken growth as credit would become more expensive, non-performing loans would increase further, leading to a deceleration in output. In the committee's opinion, the upward adjustment would not only signal the bank's commitment to price stability, but also its desire to maintain positive real interest rates. A decision to hold all policy parameters constant would sustain gradual improvements in output growth. There is need to maintain the current monetary policy stance and await a clearer understanding of the quantum and timing of liquidity injections into the economy before deciding on possible adjustments. The MPC, however, called on the government to fast-track the implementation of the 2018 budget to help jumpstart the process of sustainable economic recovery and to facilitate passage of the petroleum industry bill in order to increase the contribution of the sector to overall GDP. The committee's decision. In the light of the above, the MPC decided by a vote of 7 members to retain the MPR at 14%. However, 3 out of these 7 members voted to raise cash reserve requirement by 150 basis points, an indication that left to them they would indeed tighten. The other 3 members voted to tighten by raising the MPR by 25 basis points. In summary, the MPC voted to 1. Retain the MPR at 14%, retain the asymmetric corridor of plus 200 and minus 500 basis points around the MPR, retain the CRR at 22.5%. I repeat, notwithstanding that 3 other members would have loved that the CRR be raised to 24% to tighten, to actually signal that they would prefer to tighten. And 4, retain liquidity ratio at 30%. I thank you for listening.
Thank you, Mr. Governor. My name is Matthias Okwe of the Guardian newspapers. Mr. Governor, thank you again for the quick action you took in the case of Skybank and Polaris Bank. You just raised a concern here about NPLs. Can you tell us what is the present situation? Because I believe that it must be very big for you to raise it at the committee. We would like to know if there are still other issues with other banks. Thank you.
Okay. Mr. Governor, I just want to add an addendum to what he's saying about Skybank, because a lot of people are worried that why didn't the CBN and the NDIC leave Skybank to be the way it was and not just giving it a sexy name, Polaris Bank, and allow it in the hands of the same management, the same staff, and pumping 786 billion for them. They are pointing at the fact that it's just like you coming up with a very good paint and pouring on the same car that the same drivers that you are retaining have mismanaged. So I don't know exactly, do you think that was the decision to take in that score? Then on the issue of the MTN, sir, can you give us an update as to what is the status of that transaction, sir? Thank you.
Thank you, Governor. My name is Sonia Adejoku of the Nigerian Tribune. As a history of Skybank, there are insinuations that as at Sunday, the bank has not been registered, the Polaris Bank. Is that correct?
This MPC is not about Skybank.
It's a financial issue. Mr. Governor, good afternoon, sir. My name is Mark Sebo from Leadership Supers. I want to ask, beyond asking the federal government to intensify effort in implementation of the 2018 budget, is MPC actually concerned? And by now, we don't have a single naira released to the implementation of 2018.
Okay, the last question.
Good afternoon, Mr. Governor. My name is Elisha Babu. I work from Godwin. My question relates to the MTN situation. This morning, Standard Bank did issue a statement that the Central Bank is reviewing some of the conditions and actually not to pay, no longer pay more than the $2.63 billion that was initially mentioned. My question is, why does the Central Bank seem to be softening its stance now on its initial stance, especially given the way the announcement was made a couple of weeks ago? And secondly, are you able to respond to criticism that the way the Central Bank handled the issue was a little bit dampening for investor confidence?
Good afternoon, Mr. Governor. My name is Gabriel Momo. I report for ITV. I want to know, based on the CRR framework that you released last MPC, how quickly are you going to start drawing down on the CRR lending?
CRR issue, you recall that we only unveiled the framework just about 3 to 4 weeks ago. And I do know that the banks themselves will, first of all, go out marketing their clients, come back and begin to make presentations to their credit committees, and then reading the guidelines thoroughly as to what qualifies and what doesn't qualify. The bank should just be about sending their requests. Yeah, we have received a few requests, but I think it's important for me to reiterate the reason for this. The essence for putting that framework in place is to see what the monetary policy authorities can do to support government's effort in stimulating growth in the country, particularly in the agricultural, manufacturing, and other very important sectors of the economy. And we are very, very optimistic that this would work. And the kind of signals we've received so far are very encouraging, and we're optimistic that very soon the effects will begin to permeate the system. Matthias Okwe talked about the quick action on Sky and Polaris, the NPLs, what is the present position with other banks. Let me again repeat that the strategic health of the Nigerian banking industry remains sound. And I would put it by saying that in every chain, right, there will always be strong points and weak points in a chain. And what we would love to see is to continue to ensure that that chain remains strong in all aspects of it. But notwithstanding that, as we see areas where there are weaknesses, we'll do everything possible to make sure that we keep the chain link together. And that's what we're doing as much as possible. And I've said that I would love to see a situation where banks are not liquidated, that we have to think outside the box to see to how we can ensure that we have more banks in the country rather than have less number of banks in the country. And that is what we're doing. But of course, the situation with Skybank, like you all know, is that as at 2 years ago when the news broke, the bank has slided into negative capital as a result of non-performing loans. At that time, we compelled the entire board and the executive management to resign, and they left. At that point, before we conducted the forensic audit, the whole was about 370 billion. After the forensic audit, it came to the level that it is right now, and which is almost about, I would say, close to about 800 billion. And what we decided to do is to say that having established the whole at this level, and that if taxpayers' monies will be invested in this company or in this bank, in this case though as a loan, that there is a need to let shareholders know, particularly, and I repeat, particularly, those we consider to be prominent and important shareholders, that they've lost their investments. We will try, just like we have done in the case of, say, depositors, to make sure that the small investors remain protected under some arrangement, but notwithstanding that fact, their holdings will be substantially whittled down. So that's what, but we're trying to say that, and it goes to the issue of why did you give it a sexy name and instead of leaving it as the name that it was before. The name had to be changed for legal reasons. Haven't gotten to a point where the Central Bank of Nigeria and government has invested close to 800 billion in this bank. At some point, it must be seen to be owned by the CBN until we find investors that can pay a fair value, a fair price for this enterprise. That is the reason, that is the compelling reason the name had to change. Okay, insinuations that the company wasn't registered is false. It was first of all registered as a limited liability company a few weeks ago and was registered as a bank on Friday, right? On Friday, a day before we took that action. I've seen some of the documentation that people were banding around because they went on the internet to check whether a company is registered. It's important for us to know that servers may not be indeed be updated. If that server that they are looking at is not updated, it does not mean that this bank was not incorporated. And I think we should just ignore those kind of sentiments and let's focus on the real issues, which have to do with that. We are embarking on a journey to keep a bank alive, to protect depositors' monies, and also ensure that we don't throw over 5,000 staff of that bank into the labor market. Now on MTN, it said update on the transaction, and I will combine that with Standard Bank advising the central bank. First of all, it's important for us to know that is it fine or penalty now? We'll call it the 8.1 billion is dollar equivalent of MTN's naira generated from their profit. So I would neither call it a fine or a penalty. What central bank sought by asking MTN to return their money is that we want a reversal of that transaction because it was not finally authorized by the Central Bank of Nigeria. That was what we sought to do. And because those funds moved through these four banks, the quantum of dollar that passed through the banks was what we said the banks needed to remit back, or the company needed to remit back to CBN through the banks. It did not mean that these were the bank's obligation. And we understand that there was some interpretation in some quarters that aside from the naira penalty, that there was some understanding or some conclusions that those dollars attributed to have been remitted by this bank on behalf of this company were indeed the liabilities of the banks. And that is the reason we provided the clarification to the bank when they called us that that liability is indeed that of MTN and not theirs, and that Central Bank was not in any position or in any way going to debit the banks for the dollar because it was not and is not meant to be their liability. Now, but in terms of update, it's important to know that, I repeat, this was an investigation that started over 2 years ago. There were a number of issues. About two of the issues we decided to allow a dispensation to say let it go. But on this last one we thought no, that the amount was large and that there was a need for us to subject this to further investigation and discussions. yes, and to give, and I feel vindicated that in the history of the banking industry that at least I gave a chance where the regulator, the governor sitting in a meeting, deputy governor, director of banking supervision, with over 20 examiners sitting in a hall with the company and the banks, asking them to resolve the issues. Because we admit that MTN is a systemically important telecom company in Nigeria. And after that meeting that we held on May 25, 2018, the discussions was inconclusive. We gave the company and the banks 1 week, which was meant to be end of May. It was not done. But also realizing the importance of this company so that we would not jolt the system, we gave extra almost 2 months for them to conclude providing relevant documentation to the examiners so they could knock those items out of their outstanding items. Unfortunately, this didn't happen, and we felt that we couldn't wait indefinitely. And that was the reason we released the investigation reports to the banks and the company. They have now responded. They have provided documents which I have sent down to the examiners to now begin to review. And I repeat, we will go through the pain again to invite the banks and invite the company to prove their case, because it is just normal that we should allow this company and the banks to clear themselves. That is what we're doing, and I believe in due course we should be releasing, we should make a final call on this subject. So, but again, it's important, something I talked about foreign investors. It's important for me to say that and repeat at this meeting that the sanctity of our CCIs remains sacrosanct. At the time, CCIs were being issued by Central Bank of Nigeria, but in order to provide a transparent system, we migrated the process to banks issuing the CCI. Today, we have migrated it into what is called electronic CCIs. So that tells you how transparent we are on this subject. And I repeat, the sanctity of CCIs remain sacrosanct. We will respect CCIs. But again, it's important that people should please, as much as possible, ensure that they do what is right, obeying the extant laws and foreign exchange regulations of our country. We would resolve this matter. I am very optimistic we'll resolve the matter, and I believe that everybody will be happy. MTN will be happy, the banks will be happy, CBN and government would be happy. Thank you.
Thank you, Governor. On that note, I think all of us are happy. So we can now go back. Please write well, represent us in your write-up very well, and in your broadcast. God bless you. And please go home and be happy.
Can we listen to this, please? Oh, let me go to my office. Thank you. See you guys. So see you now. See you in November. Bro, are you